Okay, well, welcome everyone to day 2 of CopenhagenMacro Days. We're very happy with everyone, all the talks, great talks yesterday from our 4 juniors. In this section, we're going to have one plenary session by Gauti Eggertsson, and then that's going to be followed by a Gauti Eggertsson from Ravn University. That's going to be followed by Morten Spange from Danmarks Nationalbank, and then we will follow that with a 15-minute Q&A session. So without further ado, Gauti, you have the floor.
Okay, thank you very much for inviting me to this conference. And although it's disappointing not to be in Copenhagen, as I had been expecting when invited, I'm still happy that you decided to go through with a virtual session. Okay, so what is this paper about? This is a paper about the possibility of setting negative policy rates. So this is a policy a host of central banks experimented with following the 2008 financial crisis in the hope that they could stimulate aggregate demand. Violating therefore the zero lower bound that people had thought was constraining policy rates. And the focus of this paper is going to be the effect of that policy measure. And now this policy measure is going to have an effect through a host of different channels. But the channel that we are going to be focusing on here is going to be the bank lending channel, which, is the main mechanism most people believe monetary policy has its effect. I would say that at the beginning of this policy, there was considerable optimism about from central banks that this would work. This just gives you a couple of examples of the kind of commentary one would see from central banks at the time they implemented or before implementing these measures. Here's one status report suggesting the loss of economics do not significantly change when interest rates turn negative. Another suggesting that if these cuts are not too large in negative territory, all channels of the transmission are expected to be active. And another suggesting that there's nothing really special about going into negative territory. So just to, so when I give this talk, I have found myself being spending most of the time talking about the data and not to get at all to the model, which I think is an important part of this paper. So I figured I might give you a little bit of an outline of the model now in the beginning in case I don't get to the framework at the end. Now, so just to remind you, sort of prior to let's say prior to these experiments with negative rates, this was sort of a typical CLB analysis. So this was of the kind, for example, I self used to analyze, in the early 2000s, where aggregate demand was given by consumption Euler equation or an IS equation, YT output, here the nominal interest rate, here an exogenous disturbance, the natural rate of interest. And then, the analysis proceeded by assuming that the nominal interest rate could not go below 0. And hence the zero lower bound. And now, these policies of central bank suggest that perhaps this was premature to impose this lower bound. So, from the commentary of the central banks, you might have thought that, well, actually, the only thing we need to do here is just to correct the mistake here that the interest rate could not go below 0. Perhaps there is something else, it's a different bound that is not 0, like say the effective lower bound. And in fact, that's how a lot of central banks talk about it now. They don't talk about the 0 lower bound. They talk about the effective lower bound, thereby sort of implicitly thinking that perhaps there's nothing special really about 0. So the approach we take here is somewhat different. So here, there's only just one interest rate that faces both the consumer and is the risk-free rate, and also is the instrument of policy. So here we're going to instead think about heterogeneous agent New Keynesian model. This is a model with a borrower and a saver. And there, we're going to derive the same type of relationship as you see in the standard Keynesian model. But what you see here is not really going to be just a risk-free rate that the central bank controls. Instead, this is going to be a deposit rate a saver gets when he deposits his money at a bank, okay, YTD. And this YTR is now going to correspond to interest rate on reserves, which is the instrument of policy in most central banks. And this now is going to refer to the interest rate a bank has, let's say, at the Riksbank, if it deposits balances at its central bank. So what we're going to see is that this interest rate, the interest on reserve, is going to have a bound, and it's not going to be zero. We're going to call it the policy rate bound. So why is it that the central bank is going to be able to have negative interest on reserves? Well, because the reason the banks deposit balances at the central bank is because they can use those balances to settle interbank transactions. And those are valuable. If they wouldn't do it through the central bank, they will have to wheelbarrow dollars from one bank to another. So this has value to them, so willing to pay for them. But they're not going to be willing to pay infinite amount for it. So there is going to be a bound there as well. The bound on the deposit rate is going to arise from a different consideration. So perhaps consumers are willing to pay for the transaction services generated by having a checking account, but there's going to be a limit how much they're willing to pay for it. So there's going to be also a bound on the deposit rate that consumer are willing to tolerate at commercial banks. Now, this immediately then gets you to think about, well, we need to then think about, well, what's the transmission here from the interest on reserve, which is effectively the policy rate the central bank can set, and then on this here deposit rate. And for that, we need to think about the banking sector. So YT is now going to be the sum of consumption of borrowers and savers, right? And furthermore, this here, which is usually in the standard Keynesian model, an exogenous thing, the natural rate of interest, is now going to be a function of the spread between the borrowing rate and the deposit rate and some exogenous disturbance. Okay, so the question now is going to become, there are going to be different bounds now, one that constrains policy and one that constrains the rate the banks can offer their customers. So we're going to want to ask then the question, what is the transmission of the policy rate to the borrowing rate that borrowers face, the deposit rate depositor face, and then how these feed into the natural rate of interest. Okay, so so in other words, we're going to be focusing on the transmission of YR, the policy rate, to the deposit rates of deposit, which is the main financing cost of banks, and then how that transmits into borrowing rates. And we're going to ask this both from a theoretical point of view, but also empirical point of view. Okay, so what we're going to find in the regular case, both in the model and the data, is that these are going to be moving roughly proportionally under regular circumstances. So the central bank cuts interest on reserves, and that affect the main financing cost of the bank, namely the deposit rates it offers depositors, which then feeds into the borrowing rates borrowers face, and that's going to then stimulate demand. However, things are not quite the same as they start moving into negative territory, even if the central bank surely can charge for the transaction, the charge for the reserve held at its facilities. So what we're going to see then, as you start charging negative rate on reserves, the transmission to the main financing source of the banks breaks down. The banks are not going to be willing to charge very negative rates on the depositors and in that case, what we're going to see is that the effect on the borrowing rate, and that's essentially, how monetary policy is getting its power, is going to become ambiguous. Okay, and it's going to depend in the model on the exposure of the bank to negative rates. So I'm going to explain to you what this FRNA stands for in a minute, but it's essentially going to boil down to a condition. Now, what about in the data? in the data, we're going to find, in the case of Swedish banks, that in fact, as they move to negative territory, that rather than lowering rates, as it would do normally, instead a borrowing rate slightly increased, if anything, although, you know, the evidence is not particularly strong, but there is certainly a collapse in the transmission to borrowing rates. Okay, so let me give you an outline of the rest of the talk. I'm going to first talk about data, and usually this takes me quite a bit of time. That's why I sort of gave you a flavor of the model already, which I hope I will get to. And the focus is going to be on Sweden because for a couple of reasons. One of them is that we have, they did 4 cuts in negative territory. So there's a bit of variation to work with. We also have some nice daily data on mortgages that we can exploit to get a relatively tight identification. And the bottom line there is that regularly cuts in policy rate are gonna move the borrowing rate almost 1-to-1, but that pass-through is gonna break down once it no longer filters into the deposit rate, and there's gonna be there a mild increase in borrowing rate. We're then gonna put this into a model of the kind I already sort of sketched out. First partial equilibrium to derive the condition I showed you here. What are the conditions for negative rates being contractionary versus expansionary? Then we're gonna put it into general equilibrium and ask some, try to assess the quantitative importance of these. Okay, so let me start with the data. And I find it useful here to actually just show you the balance sheet of banks, sort of organize here oops, I'm trying to organize the discussion here around the balance sheet of the banks. So on the asset side, the bank has interest, it has reserves, and the central bank controls the interest on reserves that then directly feeds into the repo rate, which is the policy rate of the bank. And we're then going to explore how we're first going to see how does policy rate translate into the deposit rate, how is it going to translate into the external fundings of the banks, and then we're going to see how it translates into the lending rates, which is going to be the main focus. And then we're also going to take a look at what happened to stock prices in reaction to rates moving into negative territory. Okay, so the first thing is, I think, relatively well known by now. So you can see here, this dashed line is the policy rate, and these here are the deposit rate by households and corporations. And you can see that these are moving pretty closely in the data in positive territory. However, as the interest rate, the policy rate moves into negative territory, the rate offered to depositors and corporations do not follow. Okay, so the transmission, the pass-through from YR to the deposit rates breaks down. So deposits are about 50% of the balance sheet of banks in Sweden, which is, as I said, is going to be our main focus. It's actually a bigger share in most other countries. So one thing to note is that we checked that the fact that they did not follow into negative territory, this was not made up by increase in fees. Let me also note that in many other countries, although we didn't find it in Sweden, one can find evidence that for larger depositors, non-financial corporations, they have started, especially in the EU area, they have started charging somewhat negative rate. But again, even in those cases, there is a substantial decline in the pass-through. It's something maybe 40% pass-through. So the evidence seems to be pretty conclusive that the deposit rates are not falling. Once you move in negative territory, the deposit rates are not moving with the policy rate in the way that it did before. So the next figure here shows you just that, which is not obvious from this figure because of the scaling, is that it's really the last two. So there are 4 rate cuts in negative territory in Sweden, from 0 to -0.1 to -0.25, and then it's in the final 2. This shows you the relative change in the deposit rate in response to the policy rate cuts. It's really just in the case of the last two interest rate cuts that there's no transmission to the deposit rate. This is what we're gonna call the cuts associated with the deposit bound. Now, so these are not the only financing sources of the banks. They also finance themselves with bonds. So if you take a look at covered bonds, they did seem to decline somewhat with the negative rate, but there is a slight decrease here in the transmission. The curious thing, however, is that the banks, even if they follow a little bit closer into negative territory than the deposit rate, we show that in the paper that the banks did not start to rely more heavily on external bond financing on covered bonds. In fact, it remained. In fact, they started relying more on deposit financing relative to bond financing. Finally, it's often suggested that as a measure of success of negative rates, that you do see here a relative close pass-through to what we called here liquid assets. So one thing here is just the STIBOR rate, which is the measure of interbank lending. Now that follows pretty much one-to-one with reserves, which is not surprising since the banks can lend the reserves to one another, and if they're getting negative rate on reserves, that's going to be translated into the terms of interbank lending. I think more noteworthy here is that the government bonds are also interest rate government bonds are following closely into negative territory, and as I said, this is often mentioned as a measure of success of these policies, and we have seen negative rates on government bonds in several countries that implement these. Now, this, of course, could be thought of as a success of the policy from the point of view of government finances, because now they don't have to pay as high a rate on their debt. However, from the point of view of the bank lending channel, I would like to point out to you that this is in fact bad news for the bank, because these liquid assets show up on the asset side of the banks. So why are the banks holding these liquid assets? Well, most banking models, and ours included, assume that the banks are holding these liquid assets against their financing, either deposit or external financing. They're holding these assets for liquidity reasons as an insurance against, a lot of withdrawals. So this, the fact that these are now turning negative hits negatively the asset side of the bank. So, negatively affect their net worth. So that's in fact, from the point of view of banks, bad news that the transmission is so strong into liquid assets. Okay. Now, finally, and this is the key main question of the empirical part, is because, we think of the bank lending channel as working by the Fed or the Riksbank cutting rates that then being affected in people's lending rates, be it mortgages, car loans, and so on. So now we're going to look at that. Now, it's hard to do that through aggregate rates because for a lot of reasons. One is that they're not that high frequency, but also, and more importantly, because the composition of borrowers is changing over time. And this is particularly the case in Sweden, because there were a host of changes in, that the supervisory authority made about lending, and in particular amortization, the speed at which you need to pay back your loan, that is changing over time, that make inference looking at transaction data pretty difficult. Instead, what we do is that we look at daily mortgage rates of listed rates. So it doesn't have this compositional issues. And we can tightly then identify the effect of policy rate cuts via daily windows, okay? And that's what, and as I said, these are the listed rates, so they don't take into account that borrowers may get discounts based on, LTV ratios, the speed at which they pay down their loans, and so on. So we avoid some of those issues that are going to be the case with transaction data, which the Riksbank likes to emphasize. But I think they have this difficulty that the composition becomes an issue. I'm not going to have time to go into the details of this. We have had some debate with the Riksbank about those data, but let me instead just show you what we do. so this here, so here the lines here shows you the day of each rate cut here, you know, from 75 to 25, from 25 to 0, and these last 4 lines are negative rates. So what I'm going to show you, this is for 3-month mortgages, floating rates, which is the most common form of mortgages in Sweden. I'm going to show you for the 12 main banks the listed rates they are offering in daily frequencies, okay? And that's these here lines, okay? So these here they are still in positive rates here. So what I want to point out to you is that at the day, so this is daily data, each line corresponds to the rate each bank is offering. As you can see, at the day of each cut, essentially all of them are slashing their mortgage rates. Okay, the same thing here. Here, 75 to 25, 25 to 0. Here you start seeing, this is again 3-month mortgages. Each line corresponds to each bank. You can see that for the first 2 rate cuts into negative territory, something is afoot, and something even more obviously is afoot for the last 2 rate cuts from minus 0.25 to 35 to 0.5. You can see that the dispersion is increasing, and it's no longer even obvious that the rates are following. So I'm not plotting up the policy rate here. I'm listing here what is going on with it with the vertical line denoting the time of each rate cuts. This is even more obvious for 5-year mortgages, which is not quite as common as the floating rates. For whatever reason in Sweden, they're mostly a floating rate contract. But you can see here, you know, they're following relatively closely in positive rates. As you breach the 0 boundary, you know, the dispersion increases, and the direction is not obvious anymore. Okay, so what we do to sort of formalize, I just want to show you the figures of this underlying evidence. What we do is that we have these daily data for 14 interest rate cuts since 2009, most of them then in positive territory. We estimate the pass-through in a 60-day window around the policy cut, and there's only one overlap where the 60-day window is not sufficient. We scaled interest rate index so that minus 100 means 100% pass-through. So here, this here is the mortgage rate regressed on a daily dummy here, and this here is then the pass-through coefficient. So if this here is if this is 100, that means that there's then going to be a 100% pass-through. Okay, so this is the dummy for the interest rate cuts, and here we have an interaction dummy where the deposit bound becomes binding. Okay, when you know, the main financing source of the banks is no longer responding. So this here is then the result, and what you can see here is that in anticipation of cuts, there is some reduction in rates according to this metric. By the way, in constructing this index, we are aggregating over all the mortgage contracts based upon their size in the bank's portfolio. Okay, so this is a synthetic index of the 3-month, 1-year, 5-year, and so on. Okay, so in anticipating cut, we see some reduction. And then here, you know, just 10 days after the Riksbank had cut its policy rate, there's about 72% pass-through to the mortgage rate. When you go to 30 days, it's about close to 80% pass-through. But here is then the interesting thing that when you interact with these 2 dates, when the interest rate reduction by the Riksbank is not being transmitted into the deposit rate, which is the main financing source of the banks, well, then this thing here flips. So you can see that this coefficient here is also statistically significant, and you take the sum of the 2, and you get that, according to this estimate, the mortgage rate, listed mortgage rate, modestly increased, although, you know, it's not a very big increase. And you can already sort of see it from the figures I showed you. This just formalized this evidence. Now this here just takes each of these here coefficients. So I just had each day in 5-day increment, just to simplify. Here I show you each and every day with a dot, and then 95 confidence interval. This here is what the pass-through is estimated according to this regression for any for a given interest rate cut. Okay, remember I normalized the interest rate cut, so minus 100 is 100% pass-through. Okay, so this is what you would expect. Now I put here the 2 last interest rate cuts. You would have thought that the mortgage rate would have followed this pattern here. Instead, they modestly increased, if anything, for these two last cuts. Okay, so I have a couple of other, so here the basic hypothesis is going to be that, you know, the deposits, which is the main financing source of the bank, stop declining with the policy rate. So that leads them not to pass it through to borrowing rates. If that hypothesis is correct, you would see this particularly being pronounced with those banks relying more heavily on deposits. And this here regression is suggesting that this is in fact the case, where we are here looking at the pass-through as a function of the deposit share. And we find some relationship there in a way. So each here bank is weighted by its size. And this is just a basic simple regression that supports that those that relied more heavily on deposits were less likely to pass, or more likely to have a negative pass-through to borrowing rates. This here then shows evidence from volumes that those that rely more on deposits, they you know, had a lower increase in their lending volumes than those that relied less on deposit share. So I'm sorry, I'm just flipping through this because I don't have that much time left. And then finally, this here shows evidence from equity returns. And this shows that in on the days, well, normally interest rate cut tends to be associated with increase in bank equity values at the time that for those dates when they were cutting rates into negative territory, the equity of the banks went down. And this is consistent with evidence we have seen from Japan and Europe, where equity values of banks seem to have gone down relative to the overall stock market. Okay, and that's actually sort of a neat result because the condition for policy rate cuts being in negative territory, being expansionary, is essentially that their net worth is positively affected by it. You know, so you should, and one then test of that condition would be to look at what happens in the equity markets, and that's the kind of evidence we see here, suggesting that the bank's profitability was negatively affected by. Okay, so let me just, in the last few minutes I have, sketch out first the partial equilibrium model, and then just briefly mention the general equilibrium model that we embed then the partial equilibrium in. So this year, the banks are maximizing net present value of dividends, and the balance sheet you have seen, they collect deposit and they get external funding that have different rates associated with them. And there's going to be a deposit bound that may possibly be binding. And on the asset side, they hold reserves, money, and liquid assets. And remember, that could be like government bonds. So if there's strong pass-through to those liquid assets, that negatively affects their profitability. And then they extend loans. And there are these three, things that affect, so this is just about then the evolution of its balance sheet. And then they face liquidity cost, or they insure themselves against liquidity risk by holding liquid assets, which are reserve money and all the liquid assets, against their external funding, okay? This here is then why they hold reserves of money to facilitate interbank transaction. And then there's going to be a function that there's some cost of extending loans that increasing the amount of lending, for example, due to default. And that's also going to be function of N, which is net worth. And then there's a storage cost of holding money, which is going to imply that they're willing to accept some negative rates on reserves, but there's a limit to it. At some point, they're going to just want to take out all the reserves they hold at the, say, the Riksbank, if the rates are negative enough, hold it instead in cash and do interbank transaction themselves. Okay, so I'm just gonna now, I think if I ask Kurt, I guess I'm out of time, is that correct?
So I started like a minute too late, so I mean, maybe take one more minute and then wrap up.
Okay, so let me just take one more minute and just tell you what is in here without going through the derivation. So first, what we do, we derive that there's a policy rate bound that, you know, yes, and we haven't, no central bank seems to have hit it yet. And this just gives you an example. And the policy rate bound arises because if the banks charge too negative of a reserve, interest on reserves, the bank will just convert the reserves into cash and execute interbank transactions themselves. This here then shows you in the partial equilibrium model that if you cut, what's the effect of cutting rates? So interest on reserves is going to be translated directly to the deposit rates if the deposit bound is not binding. And that's going to directly be translated into increased lending. The second experiment asks then what happens if the bound on deposit is binding. You cannot cut rates, that the banks will not reduce their deposit rate further because the customers are not willing to pay not to pay negative interest on their deposits, at least if it's below this bound. And there we show that whether or not interest rate cuts are expansionary or not, and this is going to be the last thing I'm able to say, depends upon the effect it has on the net worth of the bank, which is given by this coefficient here, omega p, which is here determined by this condition here, which says that this is basically the exposure of the bank to negative rates. If its liabilities, so its external financing, is affected, if the rate goes, if their liabilities are affected more than their asset sides, then it's expansionary, and vice versa. If negative rates hurts its profitability by really they're now have lower rates on their asset side because they're holding a lot of government bonds and reserves, and now they have to pay. It's paying negative interest rates that reduces their profitability. Then there's going to be a negative effect. So that's the condition. We argue that it's satisfied in Sweden. It may not be satisfied everywhere. We then put this in general equilibrium that takes the same form as I showed you at the very beginning, where we nest the standard New Keynesian model with a banking sector and model the relationship between IR and ID. And we conclude then with a couple of simulations that use the empirical results to calibrate the model. This here is a regular recession once the zero bound is binding on both rates. Now it's only binding on the deposit rate. And then if you still go ahead and lower rates according to the Taylor rule, you get a significant additional recession. And that's because of the negative effect it has on the profitability of the banks. Condition on the condition I showed you being satisfied. Okay, so the central result is that negative rate cuts are not a substitute for interest rate cuts in positive territory. They're fundamentally different, and they operate through the profitability of the banking sector. That can go either way. In the calibration we have, it seems to go the wrong way. And that concludes the presentation. I'm sorry I had to rush through the end. I posted this newest draft on my website, and I hope this at least gives you a reason to take a look at it on my website. Thank you.
Okay, well, thanks a lot, Gauti. If you can stop sharing your screen so then we can get Morten to get his discussion slides up. We're looking forward to his discussion, and I'm sure in the Q&A we'll be able to kind of dig in deeper if some people have questions on things you weren't able to fully cover at the end. So, Morten, you can take it away. You need to unmute yourself, Morten. We can't hear you if you're talking.
Sorry, I think I'm unmuted now.
Yeah, we can hear you.
And now you can see my slides as well. So let me start by thanking the organizers for inviting me to discuss this very important paper. It's obviously a paper that's attracted a lot of attention in central banking circles, as a number of central banks have recently reduced policy rates into negative territory. And while I was preparing my discussion, I also actually realized that the authors had released a new version of the paper, which kind of addressed a couple of the questions I had to the previous version. So that's quite nice. I have a brief agenda. First, I'll say a little bit about the context and the key insights from the paper by Gauti and his co-authors. I think I'll be brief here. Then I'll present some results from a related study that I did together with a colleague on Danish data for Danish banks. And then I'll move on to raise a few issues for discussion and perhaps further analysis. So let me begin. Just very briefly, a number of central banks have cut rates into negative territory. Most of them, not the Danish central bank, but most of them have done it with the purpose of providing expansion to the private sector in order to meet their inflation targets. So obviously it's very important to answer this question, well, what are actually the effects of negative rates on aggregate demand, on lending behavior? Are they expansionary, as for example the Riksbank has hoped for, or are there some effects that make them have the opposite effect? And the very nice one very nice feature of this paper is that it combines this empirical approach with a theoretical model. So as Gauti also mentioned, the key points that once the policy rate becomes sufficiently negative, well, then bank deposit rates stop responding to further cuts in the interest rate. And once this happens, the transmission to lending rates also breaks down. And actually, we even saw that in some cases, it appears that banks start increasing lending rates in response to further cuts in the policy rate. And here, the Swedish data suggests that there is a link between the bank's funding structure and the responsive lending rates, because banks that rely heavily on deposit funding, the hypothesis is that once policy rates become negative, well, this puts a squeeze on the profitability, in particular of these banks that rely heavily on deposit funding, and in response to that, they increase lending rates and cut back on lending. And then the model or the paper moves on to explain these features within a DSD model. And I should just mention that there are a few other papers that have looked at the transmission of negative policy rates, and the results are somewhat mixed. So I think the jury is still out here. What are actually the effects? So that's also why more analysis of this topic is very important. So I move on to a study I did together with a colleague at the Danish Central Bank. And Denmark is a bit of a special case when it comes to negative policy rates. And so we were actually the first country to introduce negative policy rates. That was back in 2012. But unlike other countries, we did not do it in order to stimulate the economy. We do it because we pursue a fixed exchange rate policy. So in order to keep the exchange rate against the euro stable, it was simply necessary to cut policy rates into negative territory. And then later on in 2015, we cut policy rates to minus 75 basis points, which is the furthest down that any central bank has gone, together with the Swiss central bank. And we also have a number of rate changes in negative territory, which have all been taken, of course, in order to keep the exchange rate stable. So in that sense, I think that even though we have a different policy regime compared to other central banks with negative rates, then our experience is potentially useful to learn from, to see what happens to bank rates, lending rates in the Danish case. So if we look at this chart on the left-hand side, then we have the blue line, which is our key monetary policy rate. And then we have lending rates to households and the corporate sector, respectively. And if we look at what has happened between 2011, so there is this slight peak in the policy rate in 2011. If we look at what happened since 2011, then the policy rate has been cut by, I think it's 1.8 percentage points in total. What we also see is that the decline in lending rates, in bank lending rates, has been almost similar. So the total decline in bank lending rates since 2011 has been almost as large as the decline in the deposit rate, even when the deposit rate has moved into negative territory. But there's also another thing that's important, because it seems to be much more lagging now, the response, compared to when interest rates are positive. So if we look at the blue bar, the blue line, then you can see that the Danish policy rate has been relatively stable since 2015, where we've still seen this gradual decline in lending rates. And I think that's also what may explain what we have on the right-hand side, because on the right-hand side, we estimate pass-through within 3 months based on some microdata for Danish banks. And we can see that the path-through from the policy rate to lending rates, it used to be around 70% within 3 months. Then after the introduction of negative rates, it declined to 30%. But actually, this may simply reflect that pass-through is lower, as we see on the left-hand side. We also did this distinction between high deposit banks and low deposit banks that Gauti and his co-authors did. And we did that for pass-through and we did it for lending growth. We couldn't really see any difference between banks that rely heavily on deposit funding compared to other banks. So our results in that sense seem to differ somewhat from those that Gauti and his co-authors find. And I mean, I think one reflection is whether this decline in the measured pass-through in the Swedish study could reflect that pass-through has become slower, but it will eventually materialize due to competitive pressures. Or is it because, for example, in the Danish case, banks are also exposed to competition from the so-called mortgage banks. So in Denmark, we have a large mortgage bank sector. And these mortgage banks, they don't take deposits. So then they're not really affected by this low bound on deposits. And their lending rates have also continued declining. So it may be that simply the banks have had to reduce their lending rates in order to remain competitive. I also included a few comments on the theoretical model. I think I'll skip that in order to save time and move on to a few other questions. So what is actually the effective lower bound on deposit rates? That's one very key question for all these studies that look at the pass-through of negative rates. And if you look at the left-hand side chart, you see the composition of how Danish corporate loans are remunerated, or corporate deposits are remunerated. And you can see that in the beginning, when we had negative rates, most corporate deposits received an interest rate of 0 or a positive rate. But you can also see that this has certainly changed within the last 4 or 5 years. So if you look at the most recent data, then it's actually almost 80% of corporate deposits that receive a negative interest rate in the bank. So this is no longer restricted to just very large deposits. It's become much more widespread. And that's also reflected in the right-hand side chart, where you can see that the average deposit rate, corporate deposit rates has declined to somewhat below 0 in Denmark. Of course, there are differences between countries, reflecting that negative rates transmit through the banking sector in different ways. And I suppose there may be some institutional factors that explain that, perhaps also some cultural factors, whether negative rates are somehow accepted by the public. In Denmark, we're even now starting to see negative rates on household deposits. It started last year with the deposit rates on some very large household deposits, but now it's becoming more widespread. So in a number of banks, they're now converging. I think it's around 30,000 euros. If you have an excess of 30,000 euros, you're likely in a number of banks to receive a negative rate on your household deposits. There are some indication that as we have more experience with the negative policy rates, the path-through becomes more like what we're used to seeing. Another important feature of the paper by Gauti, in particular in the model, is that bank profitability is negatively affected by negative interest rates. I think here there are also some different results for different countries, perhaps. I mean, there is a quite large comprehensive study by Rose et al., which looks at banks. I think it's more than 5,000 banks for European banks, where they actually, and this is the title of the paper, they conclude that why have negative nominal interest rates had such a small effect on bank performance on some cross-country evidence. In Denmark, we also see, if you look at the right-hand side chart, that we haven't really seen a large decline in bank profitability since the introduction of negative interest rates. We have seen a change in the composition such that the decline in net interest income has to some extent been offset by other sources of income. I think it could be interesting to look a bit more on the Swedish case also. How are these Swedish banks actually affected by how their profits are affected by this? Then moving on, if we accept that this effect on bank profitability is really a problem, then it raises the question, could it actually be mitigated? And could negative rates be supplemented by additional tools targeted at the banking sector in order to support bank lending? And for example, we have seen in the euro area that the ECB have conducted targeted long-term refinancing operations in order to support bank lending. So that's one example. I think if you go to an extreme, this is certainly not something I would recommend, but in principle, I think you could actually make a subsidy to the banking sector to kind of get around this problem that arises in the model by Gauti et al. That's probably not something which is feasible or acceptable, but I think it would be interesting to look at whether you could do something to make negative rates more effective. If this problem on bank profitability is an issue. There's also, in the model presented in the paper, dividend payments are a fixed fraction of bank profits, and there's not really the opportunity to increase fee income. That's also some things that could perhaps be applied in Denmark, we've seen this increase in fee income, for example. Then I think it would be interesting to look into these implications of other sources of lending. In Denmark, we have this mortgage banks that hold a large deposit, a large market share, but don't take deposits. So could that somehow explain partly these differences? I think I'm out of time, so let me just briefly summarize. I think that the paper makes a very important contribution to the literature, and in particular, I think it's the only paper I know of that really combines the empirical evidence with a very thorough theoretical model in order to shed light on this very important issues. The empirical results seem to differ somewhat from other studies, including the one that we did in the Danish Bank. So I think more analysis could be done at looking into what actually explains these differences and what would the model predict if other countries were to venture into negative territory. And then finally, it's worth discussing whether negative policy rates could be made more effective by providing economic stimulus or provide more economic stimulus if they were supplemented by other policies, or if banks make some adjustments, for example, to the fee structure or to their dividend payments. I think I will conclude here.
Okay, Morten, thank you very much for your discussion. So now we're going to transition to the Q&A. So we'll do about 15 minutes of Q&A. There's a missing 10 minutes in the program. So even though we've gone a little bit over, someone built in a behavioral buffer for us. So, we have a few questions in the typed Q&A. I would encourage you, if you have more, to put them in now. So one of our panelists, Michael Bauer, had a couple of questions that he wanted to ask. The panelists can't actually ask questions in the text Q&A, so we thought we'd let him kind of ask those live first so that all the attendees could benefit from that. And then I'll go and kind of take some questions from the typed Q&A. So while kind of Michael's asking his questions, if you've been holding a question back, but don't be nervous. You can put it into the text Q&A and I will ask Gauti.
Okay, thanks, Kurt. Yeah, so Gauti, I was wondering, about the evidence of Drexler, Hove, and Schnabel. They have, this very convincing evidence that there's very limited pass-through in the U.S. During normal times. And I was wondering whether that is a challenge for your model, where I understand you assume that there's essentially full pass-through during normal times. But it might just be that for your results, all that is needed is that there's less pass-through during, negative interest rates than during normal times. And so maybe it's just like a relative thing. But if you could comment how your model kind of relates to, this body of evidence that talks about the, deposit channel in the US and the pass-through there. And then just a second question, if I may, on like the 30,000-foot level, is the takeaway from your paper basically that negative interest rate policy is just a terrible policy because it squeezes banks and doesn't really accomplish anything in terms of stimulating aggregate demand? Did I kind of get the right takeaway there, or I'm sure you have a more subtle interpretation of your results, but I was wondering whether you roughly agree with that characterization.
So first on the evidence from Drexler, Savo, and Schnabel, I was just actually looking at the picture here. So what they show, just to make sure that my recollection was correct, is that there is not full pass-through. There's some sort of and they explain it by imperfect competition. So there's time-varying sort of markups. So I think we could include that. The important point is just that there's a bound. Once it turns negative, there is no pass-through. Once that's the important feature. I don't think it would change much to have some sort of a market structure that would try to model why the interest on deposit move a bit slower than the policy rate. You would need imperfect competition. We thought about doing it, but we didn't think at the time it was essential for the main point. Although I think it would be an interesting extension, and there may be things there that I'm missing. I'm not sure. For one thing, for example, it may be then that interest rates cuts start become contractionary even earlier than when they cross zero, because you're squeezing the market power, the markup of the banks earlier. So that was one thing, and that was one reason we were sort of thinking we might want to do it, but we didn't. The 30-foot lesson, I guess, I would take is not so much necessarily that negative rates are always a terrible idea. It's more that to the extent that they're effective, the transmission is fundamentally different because you don't have this transmission to the financing, chief financing source of the banks. I do think you can flip it and say that the paper also point towards policies you could take to make it more effective. And one of them, for example, would be to make the banks face, how negative rates they can charge their own customer, try to make that lower. There are even radical ideas like, I guess Hall said during the crisis of, in the case of the US, so the issue here is that cash is the alternative. So if the Fed doesn't print any notes higher than $20 notes, well, then the cost of storing cash is higher. So you might effectively lower the deposit bound further. But there are also regulatory things, like I think in some European countries, there are rules against charging negative rates on deposits. Obviously, if you want negative interest rate to be effective, you want to start there and eliminate those boundaries and encourage banks then to reduce those. And but no, I think it is fair to say that 30-foot lesson is that it's not a substitute for regular interest rate cuts.
Okay, I realized before we go to the questions from the floor, of course, Morten gave a very nice discussion. I think, Gauti, if you have some comments that you'd like to respond to his discussion, I mean, I should have given you a chance to do that kind of right afterwards. So if you have some comments, feel free to take a couple of minutes now, and then we'll
well, first of all, just thanks for these many interesting comments that I'm gonna try to think about more and incorporate. I think that so we tried to review in the paper. I do think that our empirical analysis is not the odd man out in terms of that the transmission is very severely affected by interest rate going negative. We cite in the paper studies from Italy, mortgages from Italy and Switzerland, where there also seemed to be evidence that rates started increasing. I think it's true that profitability of Swedish banks over this time period overall went up, but that's I think partially because there was a general recovery going on. The question is, what was the marginal effect of negative rates? And that's why we looked at daily data, where it looks like the marginal effect of negative rates on equity values was negative. And that's also consistent with some other studies on from Japan and on Japanese data and that we cite in the paper. So let me just open. Oh, and then finally, there is also evidence that, yes, sure, that they have started experimenting more with negative rates, especially on larger depositors. I think even there, though, for the largest negative rates that people are charging on depositors, it's still, not, the pass-through is certainly not anywhere close to 100%. I mean, at best maybe 40%, which is actually a number we use in the paper for external financing. Okay, cool.
Okay, we'll have our first question from the floor. That's from Adam Elborn. So he asked, how does this relate to the information content of central bank decisions, a la Jaroczynski and Karate, et cetera? An alternative explanation could be the central bank responds to bad news about future economic activity. Normally they would reduce by 50 basis points, but because of the ELB, they lower it by a smaller amount, 25 basis points. So real rates haven't fallen enough. As such, banks see the potential borrowers are riskier and ask for higher rates. So, can you compare this versus your theory with some market interest rates?
So I guess the idea is that perhaps setting interest rate negative signals some information about the future of the economy that could have affected it different from we analyze. So we don't analyze that, right? So we just try to focus on in isolation what negative rates do, abstracting from any effect it could potentially. It's true, I think that them going negative could have had some sort of a signaling effect that now they're going to raise rates slower than people expected before and so on. And, we abstract from that altogether. I don't think that's a problem in theoretical analysis. We're just trying to isolate this force. But I think you're right that once we look at the data, it could be corrupted by potential informational effect. In particular, one might be worried about the response of the equity values for the banks. That could have been going on, but I think though that I haven't seen any strong evidence for it, but I think it's a reasonable point and something to be concerned about.
Okay, our next question is from Henrik Jensen. So it's kind of a two-part question. The first relates, I guess, to some indeterminacy issues where, in kind of, it says an old 2000s literature on the ZLB, one issue was multiple steady states with often different properties. Is that an issue in your paper or could it be? And then, is this paper a foundation for actually just assuming one kind of rate is subject to an effective lower bound?
So we here are analyzing the, let's call it the regular steady state, one that is, well-behaved and stable. It's true that, if you assume something like a Taylor rule, there is in general a different kind of steady state. I have written some about it and, Morten has as well, and people have different views on it. My own view on it is that I think that other type of steady state is not particularly well behaved and not necessarily, I don't think it's a good description of what's going on, partially because it's indeterminate. And so it's hard to think about comparative statics. It's not learnable and so on. But that's a discussion we don't really touch on at all in this paper. We just take a look at what I would think of as the normal steady state that is well behind where comparative statics are well behaved. And we don't really address at all this other debate in the literature that has to do with the potential of other steady state due to self-fulfilling expectations. Here instead, the ELB is binding due to some fundamental shocks.
Okay, then we have one more question from the floor right now. So this is, I guess, asking about kind of the relationship between the model and the data. So I guess in the empirical side, you talked about the lending rate diminished by like 72 basis points to minus 72. And I guess whether was that what you kind of put into the theoretical model and the impulse responses you did, or what was the?
Okay, so yeah, I didn't. So what we did was that we assumed, and this is a bit stark, we assumed that under normal circumstances, there's full pass-through. Then what we did was, in order to parameterize the basically the elasticity of the lending function with respect to net worth and lending, we pinned that down. There are basically two parameters there. One, we picked from a study from the BIS about the effect of increased capital requirements on lending. And the second, we picked in order for the model to match the increase in lending rate on account of interest rate turning negative. That's what we So, you know, it was that 5 basis point increase in lending rates as a result of interest rate going negative. We used that from our empirical section to pin down you know, a parameter in the lending, the function for lending, which was like one of that was the key parameter in the model. So we didn't, in other words, we didn't use the pass-through in normal circumstances, but instead in this special circumstances, because we were particularly interested in potential negative effect of cutting rates in negative territory.
Okay. We've got one more question from one of our panelists. So Christina Ariano.
Yeah, so very interesting. So I had a question from the point of view of a central bank. Does your theoretical analysis suggest that it's worth getting into the details of the banking sector and sort of lower bounds for deposit rates? Or does theoretical analysis suggest like an equivalence result that, you know, we're okay with our usual New Keynesian framework, where sort of the interpretation of the ELB, you know, now would have to be linked to the details of the banking sector?
Yes, so I think it's the first, right? I think it would be a mistake just to relabel the standard model with, oh, now the zero bound is not zero, it's ELB. It's something like, oh, they've gone all the way down to minus 0.1 in the case of Switzerland, if I remember correctly. No, you don't want to do that, because once you breach the zero bound, then the details of the banking sector matter. And, you know, once you start modeling it, there are actually 2 different bounds. One is on the policy rate, how low you can go with interest rate on reserve without banks just taking out all the reserves in exchange for cash. And the second then, which is about the transmission from the interest on reserves to lending rate, there you need to be concerned about, is there a transmission to the deposit rate, and are the deposit rates bounded? And you want to then model that bound, and that bound comes about like the other bound because of the presence of cash. And so you want to think about, you know, what is the cost of instead of having a checking account or a deposit account, what's the cost of instead having, you know, a save and just stuffing it full of $100 bills? At what point are you gonna start withdrawing? And it's somewhat surprising to me, frankly, that how reluctant banks in Europe have been to charge negative rates. And maybe, I mean, maybe it's behavioral, but maybe also it's just that people think that it's not worth that much. They're willing to just take out the cash and hold on to it. I don't think we really know the answer to that yet.
Okay, well, I think that is about all the time we have for questions, and we got all of the questions from the panelists and from the floor. So thanks a lot, Gauti, for a great keynote, and thanks a lot, Morten, for a great discussion. So we're going to stick with the, we're going to add the phantom 6 minutes that we have to the coffee break, so we get a little extra time to get up and stretch your legs. So we will be back in 21 minutes. So 4:25 for those of us in continental Europe, or 10:25 for people on the East Coast. And Søren Ravn will be the chair taking things away, and you'll get to see me present. So see everyone in 20 minutes.
Okay, so it's 4:25 and I think we can safely resume. So welcome to this second session of the day in the Copenhagen Macro Days conference. Let me just quickly remind you of the rules of the game. So everyone's audio and video is on mute and you cannot change this. We're not going to unmute you though without prior consent. There's the option to ask questions using the Q&A function, which you see at the bottom of your screen. And then the chairman, which is myself, will select among the questions and post them to the speaker when we reach the end of the talk. And in any case, if your question is not raised, then the presenters will receive all of the questions that were raised in the Q&A after the presentation. So please remember to use the Q&A function and not the chat for questions. Now with that aside, let me welcome you to this final session of the day. Again, we have two presentations ahead of us. Both of which on monetary policy, but quite different, I dare say, between them. And the first of the two presenters is Kurt Mitman from the IIES Institute at Stockholm University. So if you're all set, Kurt, then I'm going to hand over the floor to you. So please share the screen and take it away.
Okay, great. Thank you very much. I'm going to do something a little experimental here. So let's see what you think of it. Okay, well, thank you very much again to the organizers, I guess, including myself, for putting the paper on the program. This is joint work with Iourii Manovskii, who's at Penn, and Marcus Hagedorn, who is at Oslo. So in this paper, what we're really after is kind of thinking about the frontier of monetary economics, which is the heterogeneous agent Keynesian model. And what we really want to do is we want to try to kind of provide, one of the first papers of, there's several people out there now, but I'm thinking about trying to estimate this model. So really kind of bringing the model to the data so that we can get kind of reliable estimates of the framework so that we can use that as a laboratory for policy analysis and for understanding kind of the differences between that and the more standard framework. Now, one of the kind of important things about the heterogeneous agent Keynesian model is that markets are incomplete. And in particular, what that is going to mean is that we're not going to have Ricardian equivalents. So if we think about kind of standard estimation of DSG models, a lot of times the fiscal side of the model is kind of ignored because you can balance the budget with lump sum taxes. Those are non-distortionary because of Ricardian equivalents. And so that kind of part is just left to the side. Now with incomplete markets, we can't do that. And why, kind of any shock that hits the economy is going to have a first order impact on the government budget. And the government is the fiscal authority is going to have to do something, obviously, in order to balance that budget. It's going to be the fiscal policy response. Now, to the extent that governments change taxes, they change spending, they change transfers, that itself can feed back into prices, into all of the endogenous outcomes in the model. So, kind of this neutrality of the government budget is no longer going to hold once you have a heterogeneous agent Keynesian model. So what does that mean? Well, that kind of the first consequence means that, we're going to need to estimate the response of fiscal policy to shocks. So we need to know when, for any kind of identified shock, how is the government going to balance its budget? How is it going to respond? And the second consequence means that, kind of conditional on feeding in what this fiscal policy response is, that potentially is going to affect kind of how we estimate all the other parameters. So, you can imagine if in response to a technology shock, if government spending increases, then, if we normally think in the Keynesian setup, a technology shock, positive technology shock would be deflationary, but spending could be expansionary. And so that, you may infer that prices are very rigid because the prices don't move, but it could be that the fiscal policy response kind of behaves in a way that counteracts the original shock in terms of how prices behave. So that's just kind of an example, but just to show how the response of fiscal policy is going to affect the responses of all the endogenous variables, which will then affect what parameters we estimate with that. So what are we going to do, with the estimated model? Obviously, once you have this model, there's lots of experiments that you could potentially run. And so what we want to try to understand is kind of quantifying what the role of the market incompleteness of the heterogeneous agent model is in shaping the response to monetary policy. There's kind of been a big push to move away from the representative agent model and to use the heterogeneous agent model. But what we would like to try to do is that, and people say that you're going to get things that are different, and this has kind of been shown in several papers, but we want to kind of develop a general methodology as a way to try to sharply quantify the differences between the incomplete markets and the complete markets models. And so for today, we're going to apply that methodology to monetary policy to understand why the incomplete markets and complete markets models are going to give different responses to a monetary policy shock. So let me talk first about how we're going to do the estimation. And so here, what we're going to use is impulse response function matching. And so the idea is that we're going to use, for today, we're going to estimate the model off of technology shocks. So we're going to have a series of identified technology shocks. And so what we need to do is we need to estimate the response of policy, kind of the entire government policy. So we want to estimate the monetary policy response, so the response to the federal funds rate, and then also the fiscal policy response, so government spending, revenue transfers, and debt. And those essentially are going to be the driving forces that we're going to feed into the model in order to match the endogenous responses in terms of the impulse responses. Now, in the model, what we're going to do is we're going to compute essentially the impulse response function to an MIT shock. So this, kind of, if you want to think about how to treat this impulse response function, following work that Timo Volpart and Per Crusoe and I did, you can think about this IRF as essentially providing the linearized solution to the model with aggregate risk. So it's going to pick up the first order effects of aggregate shocks. And this kind of relates to work that Christian Wolff has done, kind of thinking about kind of what's the relationship between kind of these local projection methods, what we use to get impulse responses in the data, and NBERs. Again, there's kind of the same parallel between kind of impulse response functions that you get from models, using those to linearize as opposed to something that's going to be more recursive, like the Ryder method for aggregate risk. So we're going to be dealing with kind of local projections in the data and MIT shocks in the model. But again, you can think about this as just other different ways to look at linear responses. And then what we're going to do is we're going to pick the parameters of the model to minimize the distance between the model and data impulse response functions. Okay, so what's the instrument that we're going to use? So there's a nice paper by Luigi Boccola and co-authors that has identified innovations to labor augmenting technology. I don't have time to go in to their paper, but essentially what they're going to use is they're going to exploit Uzawa's theorem, which characterizes balanced growth, and is a way to kind of identify Herod neutral technology shocks, which we're going to use again then to estimate the local projections and then to feed into the model. The fiscal variables that we're going to use government spending, transfers, and revenue, which we're going to construct from NIPA. And so then we're going to take debt as the residual of the government budget constraint. And so, essentially, you have all of the inflows and and outflows, and the residual is going to be the change in debt. For the time period, we're going to focus on 1983 Q1 to 2014 Q4. We're kind of, if you know kind of about these estimation, monetary policy and things kind of change pre and post Volcker. So we're going to focus on that time period, but we've done things where we extended the sample. But the things, kind of our estimates there are relatively stable in the data. And finally, like I said, we're going to use local projections. So we're going to compute the impulse responses to technology shocks. We're essentially here, at kind of time horizon K, we're going to compute the log change in the relevant variable on the innovation in period T. So basically tracing out the impulse response as a function of time in response to the shock. Okay, so this is just to show you kind of what happens in the data after a response to a technology shock. So these are going to be our policy responses. So you can think about kind of these are going to be the driving forces of the model along with the technology shock that we're going to feed in. So this is kind of what the fiscal and monetary authorities typically do in response to a technology shock. So this, it may be surprising. I guess we, didn't necessarily have a prior of what this would look like. But, this, what we get here is that spending is actually quite expansionary in response to a positive technology shock. So when technology goes up, the government kind of decides that's a good time also to spend. And so kind of over the 5 years after a positive technology shock, we get about a 7% increase in nominal government spending. Transfers also kind of go up in the medium run. Revenue, so that's kind of all of the tax receipts from kind of labor and capital taxes also increase. And then the federal funds rate kind of tightens at first and then to normal, to kind of level out. So, in response to a positive technology shock, we seem to be getting that there is going to be a tightening coming on from the federal funds rate. So again, we're not going to have kind of rules when we think about what the responses are in terms of policy in response to shocks. We're going to basically feed in this. That's what the data tells us that has happened kind of since '83. Okay, so what is going to happen to the kind of the endogenous outcome variables of the model? So we see the kind of hours initially are going to rise, but then eventually go back to steady state. So we're going to be using basically kind of McCurdy preferences, so that in the long run, hours are not going to respond to positive technology shocks. We can accommodate kind of using Beaupart-Crusoe preferences that would allow there to be the income or the substitution effect to dominate in the long run. But I guess the error bars are big enough that we could think about kind of how big of income or substitution effects we could accommodate. Investment increases, output increases. And we get kind of roughly the balanced growth result that output increases by 1%, technology also investment increases by 1%. And in terms of prices, we do get a slight deflationary impact of the positive technology shock on impact, but then in the long run we get a long run increase in the price level, and we get a positive impact on wages of technology shocks. So these are essentially going to be we're going to feed in these driving forces for policy, and then we're going to want the model to match these kind of 5 aggregate time series. So we're going to do kind of point by point matching. Okay, so let me kind of go from there to jump into the model to kind of explain what the model is that we're going to construct, and then how exactly we're going to solve it and bring it to the data. So essentially, this is going to be, for those of you that have seen a Hank model, this is going to be relatively off the shelf these days, kind of from what we've been working. So we're going to start off, we're only going to have ex post heterogeneity. So households are going to be ex-ante identical. They're going to have preferences over undurable consumption and leisure. The source of market incompleteness is going to be that households are going to have stochastic labor productivity, which is going to evolve kind of according to a first order Markov chain. But they're not going to have a full set of error securities to insure themselves against those labor productivity shocks. They're only going to be able to save in one period on contingent assets. And so that's going to give rise endogenously to a distribution of wealth and productivity across households. For today, we're going to assume that there's no borrowing. And so that the household budget constraint, we're going to write in nominal terms, simply going to be that consumption plus nominal savings is going to have to be financed out of your after-tax return on previous period savings, your after-tax labor income, and potentially a nominal lump sum transfer that you could receive from the government. This could also be negative if it's a lump sum tax. And so we'll write things in nominal terms. And again, we're going to think about this wage as being the kind of the effective wage per effective unit. So it's going to be multiplied by both your productivity, which is S, and your hours, which are H. And tau K is just a capital return, a tax on capital income. In terms of production and prices, for hours and wages, we're going to essentially follow what the way that the new Keynesian literature has put sticky wages into the representative agent model, kind of adapted here to deal with the fact that we have heterogeneity. So we're going to assume that there's recruiting firms that are going to aggregate differentiated household labor services. They sell those labor services to intermediate goods. And then there's going to be a union that's going to set the nominal wages on behalf of the households. And the union is going to be subject to a Rottenberg adjustment cost friction. We're going to treat, I'm going to say that that's as if in the sense that it's not going to be, the adjustment costs are not going to show up in the budget constraint. They're just going to show up in the optimization problem of the households. In terms of output and prices, there's going to be a final goods producer, which is going to aggregate a continuum of intermediates. There's going to be intermediate production. The intermediate production is going to be a Cobb-Douglas function in capital and labor. Again, we're going to have, as if Rotenberg, adjustment costs for the intermediate goods firms that are going to set prices. Then on the asset side, we're going to have capital. We're also going to have real bonds. And so we're going to assume that there's a mutual fund which is going to solve the portfolio choice on behalf of the households, and the households can simply invest in this mutual fund. So it's going to collect the government debt and the capital, and the mutual fund can adjust the aggregate capital stock, but it's going to be subject to adjustment costs, which we'll denote by phi. And then this mutual fund is going to pay a real return denoted by RA. The mutual fund might also generate some profits because of the adjustment costs on capital. And we're going to assume that those, there's going to be some shares, lambda MF, which it will be how those profits from the mutual fund are going to get distributed to households. So it could be in proportion to people's savings or other type of redistribution methods, but we're going to keep it relatively general for now. On the government side, there's going to be a government that is going to tax labor income and provide nominal transfers. So we're just going to have a simple affine tax function that lines up with what we had before in the household budget constraint. We're going to assume that the government is going to fully tax firm profits. We could also put those in the mutual fund, but for today, we're going to keep things simple and put them in the GBC. The government is also going to tax asset income at a rate tau k. It's going to issue nominal government debt, and it's going to have some exogenous path of unvalued expenditures. So we're going to write the government budget constraint. Now again, note, we have, here we're going to write these in terms of nominal prices. So government debt is going to be fully nominal, and we're going to specify the government budget constraint in fully nominal terms. So again, we're going to have cases here where we're going to be kind of running with interest rate pegs and fixed nominal interest rate. And this is going to allow us to get determinacy by specifying the government budget in nominal terms, which I can talk more about later. Okay, so that's kind of the basic structure of the model. Now, what we want to do is I want to kind of go through the theory to build up how we're going to do the measurement to understand the difference between complete and incomplete markets. So the complete markets version of this model is basically the version of the model where you just shut off the idiosyncratic income risk, right? If you shut off the productivity risk S, this model collapses to the complete markets model. So let's think about a steady state in the complete markets model, which is characterized by some aggregates. So, anytime I have a subscript CM, that's going to be complete markets, and then kind of the superscript SS will be for steady state, as opposed to if there's a time subscript, that means it'll be in response to a shock. So let's think about a monetary policy shock. So we'll start off in steady state, then there'll be some sequence of the nominal rate, and then we'll go back to the steady state nominal interest rate. I'm going to define these gammas as the deviations of the aggregates from the complete market steady state. So gamma CT is just the ratio of consumption in the complete markets model at time t relative to the steady state. Now I'm going to use these gammas later, so just remember those are going to be the proportional changes. So what's going to happen with incomplete markets? Well, there's going to be a distributional impact of monetary policy, which in general is going to give rise to different responses from the complete markets model. So what we want to do is we want to compute a sequence of transfers, which we would announce to the households kind of at the beginning of the shock, that would undo this distributional impact of monetary policy such that the incomplete markets model would generate the same aggregate response as the complete markets model. So kind of what are the transfers that we need to construct to make, in the aggregates, both models look the same? So how are we going to do that? So let's think about the household dynamic programming problem in response to a monetary policy shock. So the households are going to come in, they're going to have some asset and productivity position. They're going to be choosing their consumption and savings. Remember, because we have sticky wages, households are often labor supply curves. They're going to work what the union tells them to work. And so now let's think about where we basically have added this transfer into the household budget constraint. And I should be very clear. Obviously, if I was allowed to specify transfers as a function of all of households' choices in the infinite future, then it would be trivial to make these two aggregate responses the same. Here, all I need to know is essentially what your state is when the shock occurs, and then I'm going to announce the transfers contingent on the shocks that realize. So the transfers don't depend at all on your endogenous choices, so they're not manipulable. You can't somehow change your choices in order to to get a different sequence of transfers. So that's going to be where this becomes a non-trivial exercise to actually figure out how to construct these transfers to make the two economies identical. And so what we want to do is we want to make these transfers such that kind of each household individually, their consumption, their hours, and their savings are going to move proportionally to their steady state values with the exact proportion that is coming from the complete markets model. So this, CIMSS, this would be what would their consumption have been if the shock hadn't occurred in that time period, multiplied by the scaling factor, which is exactly how the represented agent consumption moved. So obviously, if everyone's consumption kind of moves in proportion the way that the representative agents does, then if we aggregate up across all of the incomplete markets households, then the aggregate consumption in the incomplete markets model will move with that same proportion. So that's what we want to do. So we were kind of part of the idea that we want to use to construct these transfers is related to Yvonne Verning's working paper from 2015, where he kind of constructed a situation where the incomplete markets and complete markets economies kind of coincide in terms of aggregates in an economy where there were no assets. So where there was only income, if everyone's incomes kind of moved up and down in proportion to the aggregate, then the consumption also moved up and down in proportion to the aggregate, and because consumption equaled output, you got that the economies had the same response to a real interest rate shock, whether the markets were complete or incomplete. So that's essentially what I've said here. And without assets, what are people's incomes? Well, people's income is just their wage income, what dividends they might be getting these are transfers. So this should be labor income plus transfers, and these are dividends from the mutual fund. And so this is just saying, for any individual I and J, we want that, relative to steady state, their incomes move in the same proportion. That was basically the idea. Now, in general, this is not going to hold. And so what we need to do is we basically need to figure out the person-specific transfers that would make this equation hold. And so it says, this is going to preserve the heterogeneity across people. These aren't, arrow securities that we're letting people buy. This is essentially used to be transfers that are going to make it such that people's incomes are going to move up and down in the same way. Okay, so, and this was kind of where Verning's paper kind of stopped. And so, obviously it was kind of a nice experiment. We want to extend this to models where we're going to have capital accumulation, we're going to have assets, and where it's not just kind of a simple economy where consumption is equal to output, and there's nothing else going on. So how are we going to construct these transfers? Well, first, what we want to, essentially what we want to do is we want to make households' budget constraints kind of all move up and down in proportion the way they would to the complete markets model. So what I'm going to do here is first, I want to take away the income change. So this is essentially the income that would have prevailed for that household if the shock hadn't occurred. And this would be, kind of the income that would happen, conditional on the shock occurring. So if we kind of subtract that out, we've kind of made their income now move in proportion to the same as the complete markets model. Then what we want to do is, well, I want to make sure that people have enough resources in order for their consumption to move this in the same way. So I got to look at the difference in consumption between what would happen in the response to the shock as opposed to in steady state. Now, again, remember in Verning, everyone, this essentially would add up to 0 because this is kind of where he stops because the first line is sufficient to do that. Now we have assets, so we need to deal with the changes in asset income. So this first term here shows the kind of conditional on what the asset choice you had before. We need to adjust the return that you're going to get on your assets. So the kind of the return that you would have gotten in steady state relative to the return that you get given the shock. And then finally, that's kind of on the income side, we need to correct for the fact that some people, have kind of more, may have higher assets kind of dynamically going on. So we need to control for the fact that dynamically their assets may have changed over time. So, you might be wondering, some of these terms here depend, kind of seem to depend on choices that people have in the future. So how are we going to make this this go away? And then we also need to control for the fact that, people accumulate assets differentially that we need to add that back in over the response to the shock. So that's basically how we're going to construct these transfers. Now, essentially, the way it turns out is that if you kind of, if you think about what's the equilibrium that we want to get, right? We want that the difference between the incomplete market's response relative to the steady state is just going to be equal to the scaling factor. Remember, these gammas were the proportional changes from the complete markets model. And that's the one operator that we want to get with these transfers. And if you add in all the terms that I had before, you can see that now the transfers, essentially those terms that depend dynamically on the assets, are going to cancel out, so that we can write this essentially just in terms of the choices that the household counterfactually would have made in steady state if the shock hadn't occurred. And then we can simply apply these scaling factors that are going to come from the complete markets model to back out what these deltas would have to be. And now, again, this only depends on choices that people would have made in steady state. So it only depends on what their initial asset position was and what the future shocks that they would receive are, nothing about what their endogenous choices would be. So that's we built these transfers. Now let's think about what are the properties these transfers are going to be. So what we want to have the incomplete markets and complete markets models are going to have the same steady state real rates. Obviously, in the complete markets model, beta 1 plus r is equal to 1. Incomplete markets model is going to be strictly less than 1. So what we're going to do so that they have the same interest rate is we're going to adjust the discount factor in the complete markets model such that they have the same steady state real interest rates. These deltas are going to be purely redistributive. So if you aggregate up across all households, they're going to sum to 0. So it's just reshuffling of resources. And the knife edge case, which is the Vernon case, is where these deltas are all identically equal to 0. Where again, by construction is going to give you that the complete markets and the incomplete markets model coincide. So these deltas are going to depend on the stationary distributions of these assets consumption, and how all the income is moving around and the cross-sectional correlations of those. And so that's what we want to get from the model to understand how the incomplete markets model is going to be different from the complete. So now, just to, I'm not going to go over the proof, but the theorem is that if we take the complete markets economy with the aggregates that I said, and then we put in the same policies, and we put in the transfers constructed the way that I said, then in equilibrium, we're going to get the same aggregate outcome from the complete markets model as the incomplete markets model. And everyone's individual consumption hours and assets are going to move exactly in proportion the way that the complete markets does. So essentially, if you understand the logic of how I constructed the transfers and you use the fact that utility is homothetic, you get everything that scales up and it works out nicely. But I don't have time to say more than that. I'm running short on time, so we just the calibration of the model, the steady state, we're going to essentially calibrate following my Hamburg chapter with Dirk Kruger and Fabrizio Peri. This is just going to give you an overview of some of the parameters. And the idea is that we're essentially going to estimate 3 aggregate quantities with the impulse responses. So we want to get the slopes of the 2 Phillips curves, and we want to pin down the elasticity of investment to Q. So this is going to come from the adjustment cost function. So if you think about it, we have we have 200 points and we have 3 parameters. So obviously, unless there was some divine coincidence, it would be a miracle if we could hit 200 points when we only have 3 degrees of freedom. So this shows you the state of the estimation where we are now. So we think that we're doing a pretty good job in terms of capturing the aggregate responses in response to the shocks. And we were surprised, but we get again that we relatively flat Phillips curves for the price and wage Phillips curve, and the elasticity from the Q again is something that doesn't sound crazy relative to empirical estimates. Okay, I just want to show you I've got maybe 2 minutes left, the importance of including the policy responses. So this shows you what happens if I turn off the response of monetary and fiscal policy and I just hit the economy with a TFP shock. You can see, again, we almost get no movement of the price level. We get the standard result. Hours are going to fall in response to a positive technology shock. Output doesn't increase by nearly as much. In the long run, it eventually does because obviously technology went up, but prices respond much less. So this is showing you what policy is doing in terms of shaping the response of the aggregates. This is to show you if you just put in the monetary policy response and ignore the fiscal response. Then remember, if you saw that monetary policy was tightening in response to the shock, then you get kind of an even bigger drop in hours. You get kind of more of a drop in the price level, a drop in wages. Output is actually going to fall in response to the shock, and so you're going to kind of be very far off from what the data is. Kind of if monetary policy response is doing that, then obviously if you drop monetary policy and just put in fiscal policy, then obviously we're going to get kind of two big movements in prices and two big movements in output. So those kind of in the end up canceling out some. Okay, in my final minute, I want to show you here kind of what now to understand. So this is kind of for looking in response to a monetary policy shock. What are the deltas that we get out from comparing the complete markets and the incomplete markets economy? So this is maybe a little hard to see, but this is the zero line here. And this is assets. So this is AIT. So what you can see is that people who are asset rich have positive deltas, and people who are asset poor have negative deltas. So essentially, in order to get the incomplete markets economy to behave like the complete markets economy, you need to redistribute resources from the asset poor to the asset rich. And so that's essentially why that's why we're going to get kind of a bigger response of monetary policy in the incomplete markets model relative to the complete markets model, because essentially to get them to be the same, you have to redistribute from high MPC to low MPC people. So, why are we getting these differences? Well, we have this distributional impact because of heterogeneity. We also, we have kind of a different price determination that we're using that I kind of alluded to briefly that I didn't have time to talk about a lot, by using the nominal government budget constraint in order to pin things down in the long run. But we'd like to kind of, in the next step, do more to kind of isolate the differential impacts of the heterogeneity from the price determination. But anyway, I'm out of time. So, kind of the simple model, this is kind of a little joke of, you could call it Hank, you call it Iourii, that generates, impulse responses that are similar to those in the data. We're still working on kind of finalizing the estimation. And we kind of have developed a framework for how to analyze market incompleteness. And we're still trying to better understand exactly how to kind of communicate what we get from these deltas. But I think the main takeaway, which again, we were talking about this kind of before things started today, is that really, you can't, you can't study fiscal monetary policies independently because they interact so much, and that you need to study the two of them jointly. So, thank you very much.
Very good. Thank you, Kurt, for a very interesting talk. While you guys out there are thinking about questions to ask, I'm going to start by asking one myself. So you show us these nice plots at the end where you could from the model where you can subtract or leave out, let's say, the responses of fiscal and monetary policies. There's also ways to do decompositions of empirical impulse responses. There's various methods floating around out there. And I wonder to what extent you tried to do an impulse response decomposition of those empirical IRFs that you're matching up against, so as to see whether this decomposition that holds up in the model is also supported by the data, so as to, let's say, dig a little bit deeper on the extent to which your model matches the data, not just at the surface, but also in what generates the responses.
So the honest answer is we have not. So the estimating impulse responses is not my, I guess, say, comparative advantage. So I was not aware that there were kind of these methods of ways to do that, those types of decompositions. But that sounds like something that we should definitely do. And obviously, to the extent that we can do these counterfactuals in the model, and we can kind of show what the relative contribution of the different policy responses is, if again that lines up with the data, would be an even better, even stronger case for kind of the testing that the model, kind of this impulse response matching methodology that we're using, is really capturing kind of exactly what's going on in the data. So I think that's like, we should definitely do what you said. So
great, excellent. There's a question from one of the panelists, Morten, Ravn. Do you want to go ahead? Unmute yourself.
Yeah, very interesting, Kurt. I just had a clarifying question, actually two clarifying questions. So one is, So if you take this model and then hold it up against micro evidence on MPCs, or actually at the micro level, the impact of aggregate shock, how does it fare there? And the other thing, so I didn't quite understand, like, so these transfer policies, like it would seem to me that like the systematic component of that would be very important, whether that's in here. So in other words, do agents sort of know this ahead or not?
Okay, so on the first part, I didn't really get the chance to go over the calibration. But so we in the steady state, we kind of use kind of standard tricks. I mean, we use what I did with Turk and Fabrizio. So we use discount factor heterogeneity to kind of match, and we get a quarterly MPC of something like 0.15. So, you know, that aggregates up to like an annual MPC of something like 0.4. So, you know, we're not kind of up to 0.6. So maybe we're a little bit low there, but we think that we're kind of in the plausible range of estimates. So in terms of, you know, kind of matching the joint distribution of consumption, income, and wealth, we do a good job kind of up to, I would say, the 95th percentile. You know, we don't have any mechanism in the model to generate kind of the top 1% of wealth inequality, but otherwise I think MPCs look pretty good. We maybe don't have as many kind of wealthy hand amounts, so kind of higher wealth, high MPC people, since we only have the one asset model, and most of the heterogeneity is kind of coming from discount factor heterogeneity. So that's something that we should look at. In terms of, so I would think of these deltas not as a policy that is kind of in the model that agents are thinking about. These are a measurement device to try to understand, you know, what the redistributions are across agents that are driving the differences. And so, you know, we don't actually, you know, we never feed those transfers into the model to solve it, you know, because we know kind of, we can compute what the transfers would be that if we were to feed them in would make them be the same. So I wouldn't, you know, obviously, like it could be that, you know, someone would run this type of fiscal policy, and then obviously you're right, you'd have to, you know, people in steady state with recurrent aggregate shocks would take into account that this is happening. Since we're using an MIT shock methodology, again, you know, these are zero probability shocks, and so agents aren't taking into account that A, this aggregate shock could happen, and that B, that there could be transfers that would respond to that. So it's all a bit first order in that regard.
Great. Let me pose a question from the floor. So Anton Narkom is asking a little bit on the link to representative agent models. So how come you chose to model the policies, the monetary and fiscal policies, in the way you did in this paper, instead of, for example, specifying a standard Taylor rule and some version of a fiscal rule, fiscal response rule, as is often done in representative agent models? Maybe you can say a few words about that, Kurt.
Yeah. So I mean, I think, you know, I'm not part of this debate, but I know that there is a bigger debate on whether, you know, whether Taylor rules can be estimated and, you know, what those estimates are. And so I think that we, you know, do governments and central banks follow rules? I mean, probably they follow some type of rule, but here we're essentially taking kind of like a non-parametric estimation of the response of policy to shocks, right? I mean, we see shocks and we see how the central bank and the fiscal authority respond. And so we're essentially kind of feeding in the non-parametric identification of the response to those shocks. Now, one could then say, well, what fiscal or Taylor rules would be consistent with kind of the, you know, these non-parametric responses that we put down. You know, and so I think that's something that we would like to do, is kind of then, you know, given those responses, kind of put in a rule that would be rationalized by those responses to see how things might behave. But here we just kind of want to be agnostic as to what the policymakers are doing. And, you know, that's kind of one of the nice features of our model, where we're kind of using theory that Marcus developed to show that we get determinacy even without having to have something like a Taylor rule in order to pin down the model, because we kind of get this missing equation from the asset demand and the incomplete markets model.
Great. I think there's just time for one more question. And we have a question from another of the panelists, Christian Wolf. Hopefully a fairly quick question. Christian, are you?
Yeah, not sure how quick it is, so I'll try my best. I'm like very sympathetic to the idea of using the impulse response in the first step to then kind of figure out what we think is a sensible fiscal response, in your case to technology shock. I was thinking, and that goes maybe a little bit back to the question that Anton just asked, if you're then interested in doing a counterfactual for a different kind of exercise, like a monetary policy expansion, for example, the question becomes, is your response of government spending to the technology shock that you've estimated part of a systematic rule where, for example, whenever output goes up, G also goes up? Or whether it's something specific about the technology shock, right? So you could also have a government spending rule where Z is an argument and not as a technology and not direct output. So I was wondering how you think about distinguishing between those two.
So that's an excellent question. So I didn't say this. So when we do our monetary policy shock that we feed in, obviously, like we've done it with both kind of the high frequency and the narrative approaches. We also estimate the fiscal response to the monetary policy shock, which we then feed in. So I guess for each, it's basically for every shock, you need to estimate the fiscal response. Right. And so, then you could then take a step back. Okay. I mean, ideally, we take a step back and do something where, you'd estimate, what the frequency of all these recurrent shocks are, and then to see if maybe there's some kind of bigger rule. But for now, we're kind of taking each, one transition at a time, one shock at a time, and one rule at a time. Yeah. Thanks.
Okay, great. Thanks to both of you for a quick exchange. And thanks, Kurt, in particular, for this very nice talk and responses. I think it's time to hand over the floor now to Michael Bauer of the University of Hamburg. So Michael is going to speak about the Fed information effect. And Michael, the floor is yours.
Okay, thanks very much. This is a paper with Eric Swanson, who's also here. So I would encourage everyone to really go ahead and shoot your questions in the Q&A. We've had kind of only a small number of questions asked so far in each presentation. So please don't be shy, throw your questions in there, and my co-author will do his best to answer them all. And we'll discuss the others after. So this is about the Fed information effect, which is an explanation that has been brought forth to explain a puzzling piece of evidence around survey regressions. So most of you are certainly familiar with monetary policy surprises, so high frequency changes in interest rates around policy announcements, so FOMC announcements, for example. And these, you would think, are predetermined, since they're like 30-minute interest rate changes, so they should presumably be exogenous to everything that happened before. If you think think in terms of efficient markets and so forth. So that's why people use these monetary policy surprises to estimate causal effects of monetary policy, causal effect on financial markets, and also more recently, kind of the macro impact of monetary policy, so the monetary transmission. And so forth. So, if you do this with surveys, the blue chip survey of professional forecasters, for example, you get the result that, these surveys seem to respond in the wrong direction in some sense. So if you have a tightening surprise, then, so interest rates go up around the announcement, then what you see is that GDP forecasts get more optimistic, unemployment rate forecasts go down. So kind of more optimism in response to a tightening shock and vice versa. So the explanation that people have come up with is a Fed information effect, which means that Fed actions really convey some type of private information that the Fed has about the economy. So this is in a number of papers, for example, Campbell et al., 2012 Brookings papers, and also follow-up paper, Nakamura Stites, and WQJ paper, Kurt Lunsford as a AR paper came out just a couple of weeks ago. And they're all about this Fed information effect. So what we do in this paper is we propose a different explanation that can also explain these kinds of patterns that you see, but that do not, this explanation does not resort to some private information that the Fed has, but it's really about kind of everyone, the Fed and the private sector, responding to publicly available macroeconomic news. And we'll show that this can really explain the survey evidence. And we present a lot of additional evidence in this paper to distinguish between these two competing explanations. We show that macro news is really an omitted variable in these types of common survey regressions. And if you count, if you include measures, if you proxy for this, then kind of these puzzles go away. We also look at the stock market. And we have our own new survey of blue chip forecasters where we kind of drill down into why they're really revising their forecasts. And we find pretty strong support there in our own survey here that they're not revising their forecasts because of the Fed information effect, but in more of a kind of standard direction in response to policy views, if at all. And then we also assess forecast accuracy, and I may have time to talk about that, but you know, really our story is about that you know, these monetary policy surprises are partly predictable, so they're not exogenous or predetermined. That you can just use them on their own to estimate the causal effect on, in this case, survey forecasts. And the reason that this is that there seems to be some learning by, or one possible explanation for this predictability is learning by investors about the Fed's policy rule. And we have a very simple learning model that illustrates how exactly this kind of learning about the policy rule, and in particular, a systematic, you know, underestimation of how responsive the Fed is, can explain all this evidence that we're presenting. So our takeaway is that you don't need a Fed information effect explanation for this evidence. Okay. So what's helpful a little bit to organize our thinking is this conceptual framework. Very simple. You have a policy rule where the interest rate I depends on some macro data in a reaction function of this data and the policy shock. And then a policy surprise is really kind of the realization of the interest rate minus what investors expected the interest rate to be just before the announcement. So now you could have just mechanically here, by definition, you could have surprise either due to a policy shock or due to some kind of different, different macro information. So like a Fed information effect in this framework would be, you know, that this macro information X is different to what markets had anticipated before the Fed set the interest rate. And, you know, these papers I mentioned are really devoting some effort to distinguishing these two channels. But we're pointing out that there's also a different possibility, a third possibility, that it could be just a different reaction function. It could be a surprise about the reaction function of the Fed that could lead to a surprise. And if it systematically goes in a certain way, then it can very easily explain these patterns we see in the data. Okay, so let's go back to the Fed information effect in Nakamura Swanson in particular now, regressing the forecast in GDP growth, for GDP growth over the next year on a measure of the monetary policy surprise, where that's, in their paper, the first principal component of basically money market futures rates around the FOMC announcement. Okay, so standard kind of New Keynesian model, many macro models imply, most macro models, that this response should be negative, right? Tightening surprise should lower our GDP forecast. But what they estimate is, you know, this kind of really significantly positive response. Okay, so what is going on here? This is really puzzling. Seems like this is a bin scatter plot of their data, and we'll show that it's actually kind of driven by a certain influential observations here in the lower left and upper right. But you know, so the story that they and others have told is this Fed information effect, where Fed announcements directly affect beliefs about macro fundamentals. Okay, so in particular, tightening surprise kind of tells the market that the Fed has some private, better information about the economy than investors, and sees the economy evolving more positively. And so the investors see this as a signal, take this as a signal, and revise up their forecast for output and employment and potentially inflation. Okay, so that has pretty strong implications for, you know, empirical macroeconomics. You know, like just one simple way to think about this is that it really means that monetary policy may be less effective. If the Fed, you know, wants to increase rates and comes up with an announcement to increase interest rates, then this may not kind of restrain economic activity or put on the brakes, but instead it could, you know, create optimism and be actually stimulated. So it's really important for monetary policymakers to know that this is going on, and they're thinking about this. Some policymakers seem to have this in the back of their minds. If you read the minutes, this is something that comes up whether a channel like this is at play. So it's a very relevant question. So our alternative explanation is there's some economic news here that really the survey respondents and the FOMC are responding to. So for example, think of a very positive employment report released in the beginning of each month by the Bureau of Labor Statistics. And for example, more jobs created than people had thought just ahead of this release. And of course, survey respondents will take this into account, will probably revise up their macro forecasts and respond to these good news. Now, if the Fed also responds by tightening monetary policy, well, let me put it this way. The Fed is going to, on the margin, respond by tightening monetary policy in response to this news. Now, if they tighten policy a little bit more than market expected, and as a consequence, you have a hawkish monetary policy surprise around the announcement, then you're going to have exactly this kind of positive correlation between the policy surprise, quote unquote, and the survey forecasts that people have documented in the data. Okay, so basically you have an omitted variable here that could potentially, that will, if these correlations are, as I mentioned, bias upward this response coefficient. If you leave out these economic news that the Fed and blue chip respondents might be responding to, and could therefore potentially explain these patterns. Okay, so Nakamura-Steinson's regression, you have these kind of really influential observations on the lower left and upper right. So in the lower left, in this figure, these are observations where there are very accommodative surprises. So interest rates are falling around the FOMC announcement and by quite a bit, up to almost 15 basis points here in September 2007. Okay, so and also survey respondents on the vertical axis here are lowering their GDP forecasts. Okay, so if you think about when this was in 2007, 2008, 2001, the economy was in recession in each of these cases. Okay. And vice versa, in the upper right corner, where you had the very positive policy surprises, the economy was very strong. So this kind of goes against this notion that these are kind of exogenous, completely predetermined policy surprise. So real surprises doesn't seem so surprising if you look at this picture, right? Negative changes in interest rates when the economy is doing poorly, positive changes in interest rates when it's doing well, and of course the survey respondents are responding in this way. So there seems to be an omitted variable here, the state of the business cycle, and potentially bad news or good news in each case coming out right before these policy surprises, these FOMC announcements. So we'll drill into this, but you can see really most of the story by looking at these influential observations. So the red observations are easing surprise and downward revision of GDP forecast in red, and green are the other observations in the upper right hand corner with a positive surprise and an upward revision in GDP forecast. Okay, so I already said that there's kind of a business cycle, state of the business cycle seems to matter. So the rightmost column has this business cycle indicator from the Chicago Fed that we like and use in our analysis, which summarizes really the state of the business cycle, in the univariate way. And 9 out of 10 cases here, there were easing surprises when the economy was doing poorly, and there were tightening surprises when the economy was doing very well. There's only one observation where it went the other way. Okay, so that's just kind of what I said before. We're quantifying it a little bit here. Then there's this other perspective on the information effect, or you think about the stock market. Okay, so papers that have already been mentioned earlier, Jarosinski-Karate, for example, AJ Macro this year, also Cieslak and Shrimp have a paper recently published. They say, look, information, if the stock market is responding in kind of this non-standard way, so tightening surprise raises stock prices and an easing surprise lowers stock prices, that really is evidence of a Fed information effect. Now, that is not what's going on in these influential observations in the Nakamura-Steinson regressions. Here, in 9 out of 10 cases, the stock market responded completely standard to the policy announcement. where an easing surprise, raises stock prices and vice versa. Okay, so the evidence from the stock market kind of also speaks against this information effect story here. So we'll drill into these in a little bit more detail. So starting with this business cycle indicator and the notion that there's something about the state of the business cycle and the economic news around the announcement that drives, that is an omitted variable in this regression. Okay. So you saw this picture before, and I mentioned the economic news. Now, of course, econometrics 101, we have an omitted variable if these news affect the dependent variables, so they affect survey forecasts, they lead to revisions in forecasts, and second, if they are correlated with the explanatory variables, so the monetary policy surprise. Okay. If that is the case, then there's a bias, we need to control for it. So the first one is, do they affect survey forecasts? Now that is pretty non-controversial, right? That you would expect survey respondents to pay attention to this data, and they do. So here are three different macro news data series. The first is the payroll surprise that I mentioned. So each month, the difference between the released total non-farm payrolls and the employment report minus the survey expectations right ahead of this release. And if you have a positive surprise, the unemployment rate forecast goes down and the real GDP forecast goes up. Okay, so just as you would expect. Then there's this Chicago Fed index, which I also talked about, which I briefly mentioned earlier, by Brave, Butters, and Kelly. Really nice little index. If you do this kind of work, I encourage you to take a look at it. Which we lag by 1 month to not run into timing issues here, because it summarizes, of course, the state of the business cycle based on data that's released with a lag. And here you also see the same kind of correlation, good business. But let me also mention the return to the S&P 500. Where we look at the stock returns right up to the day before the FOMC from the end of the previous month. So that we thought was kind of a nice way to summarize all the economic news that come out before the policy announcement. And that indeed is strongly correlated with the revision in the survey forecast, just in the way that you would expect. Okay, so that's not too surprising. Economic news predict the survey response. What's a little bit more surprising is that economic news also predict the policy quote unquote surprise. So ex post in this sample that we look at, and I should mention that I'm only showing results here for one sample. We've done it for different samples, in particular for the exact replication samples of these papers that I mentioned, and those results are in the paper and they look qualitatively very similar. But these economic news also predict the policy surprise, so the change in interest rates around the announcements. And there, we look at the target and path factors to these two surprises, short end and medium term policy path, if you will. That is using Campbell et al. Following Durkheim, Swanson. And then also the Neckmore-Steinson surprise, which is the first principal component, as I mentioned. So using all three of these measures of economic news and using all of these different policy surprises, we generally find there's significant predictability, or I should say, in sample correlation ex post of the policy surprise and these economic news. Okay, so that suggests, so there might very well be a variable bias going on. So we need to control for these economic news. So let me first show you, because I haven't actually shown you, some regression results of our own here, where you regress the blue chip response revision on the policy surprise, so kind of the information effect regressions in the top panel, where you tend to find, it is kind of sensitive to the sample chart, but you tend to find that the unemployment rate forecasts fall and GDP growth forecasts rise. Neckmore-Steinson in their sample found a significantly positive effect here for real GDP growth. In this sample, it's not significant, kind of indicating that this is a little bit tenuous, this finding. But in any case, these have those puzzling signs, right, and are significant in some cases. Now, if we control for these economic news, the sign flips. There's no significant kind of puzzling coefficient anymore. If anything, there are significant in the kind of the conventional direction. For example, the path factor here has a negative coefficient in the kind of classic policy shock sense for real GDP growth. Okay, so controlling for economic news really drives out information effects. And it's kind of one key part of our evidence in this paper. Okay, so what can explain this? So I said a crucial ingredient is that monetary policy surprises are predictable with observed macro news. So there's two basically reasons why this could be going on. One is time varying risk premia, and we're not ruling that out, but people tend to find, and Eric, has paper with Monica Biazzesi, where they say, well, they're kind of small, these risk premia, and we tend to think of risk premia as small at the short end of the term structure. So our preferred explanation here is that there is learning or violations of full information rational expectations, learning about the policy rules. So investors do not know the policy function and are continually learning about it. And in particular, if they systematically underestimated the Fed's responsiveness to macro news, then you could very well have a positive correlation between the macro news and policy surprise. So that means that you have this kind of ex post positive correlation, although the policy surprise is not truly predictable ex ante with the information that investors had at the time. It's kind of the thing that ex post, after we've seen this learning process, we observe this correlation. So we have a simple model in the paper that's really just saying what I just said in words in a few equations. So let me just say about this model that the policy surprise can generally be due to truly a policy shock or kind of an update to your perceived monetary policy rule. And where XT here is the output gap. And so if you have some kind of update in this policy rule parameter A, and if this is systematically going into one direction where A is always kind of higher than you anticipated ahead of observing this, then you could see this kind of positive correlation between XT and policy surprise. Although, of course, here it's important, you have a conditional expectations, just knowing the policy, kind of the perceived rule that investors have ahead of this announcement, and the history up to that time, and then knowing the output gap, they could not have predicted this policy rule. Only after the fact, ex post, is there a correlation. Okay, so. Well, I mean, the takeaway really is here, that learning can explain, very simple learning story can explain the evidence that's going on in the data and why these policy surprises that people use, very commonly, very widely in the empirical macro literature, why they could not be exogenous, not be predetermined, and why we may have to be a little bit more careful when working with these policy surprises. Okay, so about the stock market, we're kind of updating and adding to the classic Bernanke-Kuttner 2005 Journal of Finance evidence. So returning this S&P 500 around the FOMC announcement on policy surprise measures, which I already discussed. Standard macro theory predicts that these coefficients should be negative because, of course, tighter policy leads to both higher discount rates and lower expected profits. So leaving any kind of risk premium story aside, they should lower stock prices. The prediction of the information effect are ambiguous. If you have an information effect going on, interest rates will go up around a tightening announcement, and that will tend to lower discount rates, which will tend to lower stock prices. but the future profits are potentially higher, which might raise stock prices. And that really is emphasized by papers that look at the stock market responses to explain, these kinds of non-standard responses. So positive. These papers have observed some positive correlations for a subset of announcements, and generally argue that it's because of Fed information effect. So now I already showed that for the most influential observations in the Nakamura-Stein regressions, this is not going on. There's a standard negative correlation between the announcement and the stock return. And if we do this for the full sample, for different samples, really, we found very strong negative correlations. Okay. So it's neither going on average nor for the particular observations where you have the puzzling survey responses. So it may be going on for some other observations. There are some announcements which lead to a positive correlation, but yeah, this is not certainly prevalent in the data. So overall, we take away from looking at the stock market evidence that there's little evidence for an information effect story. Okay, so the evidence, this puzzling survey evidence, is in the blue chip, right? And so we wanted to know a little bit more about why they revise their forecasts. Now, high frequency financial data has the benefit you can kind of know better about what causes what. Generally speaking, particularly FOMC announcements, you can isolate their effect by looking at asset price changes around the announcement. But surveys are lower frequency, so it's harder. So what we did two kind of high frequency macro forecasts, if you will. The first is we looked at the daily GDP tracking from one of the forecasters in the blue chip panel, Macro Advisors, an award-winning and very influential forecasting firm. And we have access to their kind of their high frequency forecasts. And they regularly revise their forecast in response to incoming data, but they have never revised their GDP forecast in response to an FOMC announcement. So there's, this is just one forecaster, but it's kind of strong anecdotal evidence against, the Fed information effects. But then we went back to the blue chip forecasters and asked all of them detailed survey questions about why they revised their forecasts. We asked them, all 52 chief economists in the blue chip panel, we asked them, how do you revise your macro forecast in response to FOMC interest rate decisions, the language of the statement, interest rate projections, so the dot plot, and then also the FOMC's own macro forecast, the Summary of Economic Projections, or SEP. And so, to just kind of give you the gist of kind of the flavor of the responses is that here, for example, on the example with the hawkish surprise, in response to a hawkish surprise, so higher interest rates or a more hawkish statement, or a dot plot that shifts up, they do either not revise their GDP forecast or they revise it downward in the kind of conventional direction. There is only there's a handful of respondents that said it depends. And so maybe those you could classify, if you're generous, you would classify those as going in the information effect bucket, and one of them actually explicitly mentioned this. But there are none that systematically kind of always do this, that seem to think that information effects are always present and warrant revising their forecast, hence the zeros in the last row. So if you kind of count it, going back to the respondents in that survey that gave rise to this puzzling survey evidence and asking them, is this really what's going on? Their answer is actually 31 to 5 against this information effect explanation of the evidence. Okay. So we have a few more things in the paper We drill a little bit deeper in Nakamura, Steinstein, Campbell et al. Regressions. We find that they do not really appear to be very robust. They are quite sensitive to the precise sample choice, including or excluding unscheduled FOMC announcements tends to make a big difference, or the crisis. And then also they're very sensitive into what macro variable you look at. For example, all of them find that there's no effect for inflation, although traditionally that tends to be the variable where, going back to Romer and Romer, people think that the Fed might have an edge in forecasting inflation. They're also sensitive to the horizon. So with our explanation of the Fed response to news channel, it is very sensible that these regressions may shift over time because just there are different economic news coming out and with different roles of shifting forecasts. Right? And then we also did some forecast accuracy assessment. So strictly speaking, it's not necessary for the Fed to be more accurate forecasters for there to be an information effect. But that is certainly the way most people think about this, and kind of the most common kind of story that is being told. And back in the days, there was some evidence that was going on, that the Fed is a better forecaster, has kind of private information. When we looked at this, there is no forecast advantage for the Fed. The forecast errors of blue chip and the Fed are just so large that there's no advantage of the Fed over the private sector. So in conclusion, we provide extensive evidence in support of this Fed response to news channel that we propose. We challenge that there's a strong role for Fed information effects. This is just kind of summarizing the evidence again, but I just want to emphasize that these policy surprises are really exposed to quite strongly correlated with economic news before the announcement. This is something we can in principle explain with learning, but in empirical macroeconomics, working with these surprises, we need to be more careful, we think, then based on our results. All right, that's all I have, and happy to take questions.
Great, thanks a lot, Michael, for this very interesting talk. Let me go ahead and ask a question myself, first of all. There's a related paper that I'm sure you know, which is a very nice paper forthcoming or recently published on the AJ Macro by Silvia Miranda Agrippino and Giovanni Ricco. I'm sure you know very well this paper, and maybe you can. It seems to me to be very closely related to what you do, also even in the intuition that you offer in terms of informational frictions. Your model speaks about, or the small model you showed us speaks about learning, and their paper also speaks about informational frictions of other kinds. Maybe you can say a little bit more about the relationship between these two papers.
Okay. Or maybe Eric wants to say a little bit about the relationship between these two papers.
Hey, can you hear me? I can talk a little if you want.
Yeah.
So we've talked to them a fair amount. Their paper is really about, let's take the information effect as given, and then their paper is all about how do we correct these monetary policy surprises for that. And I think our paper would interact with their paper and say that we're going to say it's not an information effect that's driving this correlation in the monetary policy surprises. It's due to this other effect, this learning about the monetary policy rule. And given that that's the story, then you could just use their paper to correct these surprises for the correlation in the way that they say. So, I mean, our paper is in agreement with theirs. It's just we're taking the information effect as coming not from an information effect, but from something else.
Right. There's a question also from the floor, which also speaks to the relationship to another recent paper that also you, Michael, were touching upon, the paper by Jaroszynski and Karadi. So the question is from Ambrogio Cesabianchi. And it goes as follows. Hi, Eric and Michael. Thanks for the nice presentation. How does your very cool empirical evidence speak to the presence of interest rate surprises and equity price surprises of the same sign around FOMC announcements? Jaroszynski and Karadi show that there are many instances where this happens, even though they do not dominate, so that a full sample regression, you get the quote-unquote right correlation between interest rates and equity prices.
Well, I want to let Eric take this one too, because he's drilled into this data a little bit more than I have.
Sure.
So it's true that there are some examples of where the stock market and interest rates respond in this puzzling direction. A lot of those movements are very small. So in that sense, we would say if the movements are very small, we would tend to chalk that up to just sort of random variation in the stock market around these announcements. There are some larger ones. In fact, in the table Michael showed of the top 10 announcements, one of them had a puzzling sign with the stock market response. And if you drill into, for instance, that date, there's usually some kind of story that goes on that particular date. And I think it's in March 2001, I think it was. You can look, and if you look at the newspaper write-ups of what happened that day, it turns out that it wasn't that the Fed tightened monetary policy by more than they thought. It was that the Fed eased monetary policy that day, but not as much as the markets had hoped for. And so then you get an effect that, okay, the markets, if you look at the Wall Street Journal write-up, and there's footnotes in our paper about this, that you have a case where the markets thought the Fed was going to cut interest rates by a lot. The Fed did not come through. It only cut interest rates a little. The stock market ended up being very disappointed and actually fell in response to that. And so you can get some of these perverse correlations actually from the market being disappointed with what the Fed did. So it's not clear, the write-ups in the Wall Street Journal don't talk about information at all. They seem to talk about things like the market being disappointed.
Right, thanks. A follow-up question, or perhaps in some sense more of a comment also by Ambrocio Cesabianchi is the following. So irrespective of whether these instances that you just talked about, Eric, whether they are due to a Fed information effect or to quote unquote learning about the Fed reaction function effect, it's not clear to me that we should be using the raw interest rate surprises to estimate the causal effects of monetary policy. Or am I missing something? And I guess that's the comment or a question. Maybe you want to comment on that, either of you, Michael or Eric.
I mean, I'll just start it off with saying, this has become very common to use these variables, these policy surprises, high frequency changes over the last year, because they are presumably predetermined. So you could use them in different ways. One way, of course, in asset price, you could just regress changes in asset price around on the policy surprise and presumably get a causal effect there. That's really going back to Kenneth Kuttner's 2001 paper, and Eric has a nice paper with Sack and Swanson. We're kind of get Sack. And and then more recently, this has also been used as either proxy variables or instruments in structural VARs, right? So you use the policy surprise, arguing that it is predetermined and it satisfies the conditions for a valid instrument, to identify the structural shock. And so we're cautioning against this, but it's certainly very common.
We should mention there's a whole section in our paper devoted to answering this question.
Right. Great. Excellent. And I'm checking if there's any other questions. There's a comment. Thanks for the responses. So that's good. That was very helpful. Yeah. Otherwise, I think we're more or less out of questions, but that happens to meet us also on the fact that we're more or less out of time as well. So let me instead thank both of you, Michael, first of all, for the talk, and also you, Eric, for the comments that you offered in the discussion. Now, I want to make sure I draw everyone's attention to the fact that there's a drinks session. I guess everyone can decide whether it's time in their time zone for drinks or for something else. The link is posted in the chat, and everyone is welcome to join. I don't know, Kurt, if you want to add something at the very end.
No, just that. I mean, thanks everyone for showing up today. I'll wait a couple minutes, but I'm going to stop the YouTube now. But I'll wait a couple minutes.